Assalamu alaikum. How are you all? Hope you all will be safe and sound. Is in a continuation. We are in week 8. So today lecture for week 8 will be about the corporate governance in a deep. Uh, like uh, Corporate governance, as you all know, corporate governance is a mechanism through which organizations are controlled, or we can say corporate governance is the system by which businesses, corporations, and all the other organizations are directed and controlled. And we have a lot of discussion about the corporate governance, that what is corporate governance and what are the types of the corporate governance. Like we discuss about the types, like two types of corporate governance, that is about the internal corporate governance and external corporate governance. Both types of corporate governance are very much important for the organizations, because we have already discussed it, that through it we have to direct and then we have to control all the organizations. We also have studied about the internal corporate governance, where we have the board of directors, we have the audit committees, we have the ownerships as well. So all these mechanism in the shape of board of directors, audit committees, and management, that maybe the owners as well get together, and they control different type of organization activities in order to make the activities get more smoothly and nicely, efficiently, and effectively. So for today lecture, let me share the slides with you guys. So the slides is about the corporate governance in a deep. So before moving to the corporate governance in a deep, we have this definitions in our hand, that corporate governance is the system by which businesses, corporations are directed and controlled. Similarly, we also know about that corporate governance structures specify the distribution of rights and responsibilities among different participants in the corporations. Like if we look at this definition, that corporate governance specify the distribution of rights and responsibility, obviously uh, there should be a specific structure on the basis of which the job description, job responsibilities, and job rights should be distributed. And if it is not, or if it will not be distributed accordingly, then what will be happen? Then obviously there will be agency problem, or that is called agency cost, in between the principal and the owner. It can be in between the owner and the owner, it can be between the agent and the agent. Like I discussed, bigger pardon, between the principal and the agent, between the agent and the agent, and between the agent and the principal as well. So all these things have been discussed previously. Here we can see that in this definition, they say such as the board managers, such as the board, the managers, the shareholder, and the stakeholders, and spills out the rules and procedure for making a decision on corporate affairs. If you look all these things, then we can say that corporate governance are making the ways for board of directors, they are making the ways for the managers, they are making the ways for the shareholders, and they are making the ways for the stakeholders. Like if we bring our memory into current situation, then we have studied about the agency theory and stakeholder theory. So both of these theories can be easily implemented over here. And agency theory is the theory is the relationship between the manager and the owner. And stakeholder theory, we have discussed that every business have to take care of their internal and external stakeholders on many shapes. That is why if we look to the specific structure of corporate governance, then we can easily say that corporate governance is very much helpful to the board of directors, to the managers, to the shareholder, and to the stakeholder. In what? In specifying their distribution rights and responsibility. So, in a nutshell, we can say the corporate governance is a base, is a structure on the basis of which the organization have to be built, the organization have to be run, the duty should be specified, the responsibility among the different participants should be distributed. So these are the basics discussions that we have done previously so many times, but now we have to move to the another definition. That definition was from the OECD. Another definition is a very simple definition. Is the corporate governance is a set of mechanism through which outside investors protect themselves against expropriation by the insiders. Obviously, outsider investors, they are in a way to invest in the organizations for what? For getting the profit maximization. How they will do the profit maximization? Obviously, with the best performance of the organization. How the organization can improve their performance? Obviously, organization can improve their performance by executing the best corporate governance practices, because corporate governance practices will enhance the overall performance of the organization. So when the overall performance of the organization will be increased or improved, then what will be happen? Then obviously the outside investor will get maximum return of their investment. Similarly, talking about the internal or insider investor, there is some other ways through which they can harm the outside investors. How? Be on the basis of earning managements, they can harm the external investors on the basis of what is earning management? That is called accounting hustle bustle. Like they can do the alteration in the account, which can misguide the outside investor. And when you alter different type of accounts and you misguide the external investors, what will be happen? Obviously, outside investor will invest, and at the end he will get nothing. So in a simple ways, for your clarifications, corporate governance is a set of mechanism through which outsider investor protect themselves against expropriation by the insiders, or we can say corporate governance is a mechanism through which organizations are being controlled. Talking about the insider is both manager and the controlling shareholder, obviously. So corporate governance is a mechanism. What type of mechanism? The rules, regulation, and procedure that is executed by whom? By the board of directors, by the audit committee, by the owners of the organization. For what? For the profit maximizations. And we talked about the types of, like, broadly we can divide the corporate governance into two, like internal corporate governance and external corporate governance. And internal and external corporate governance, both are the clear cut mechanism. If followed, then organization can get a lot of profit, or can get their performance what has been targeted, or can achieve their target very easily. But the point is that corporate governance should be executed according to the plan, according to the instructions. Another definition of the corporate governance refers to the direction and oversight provided for conducting the affairs of corporate bodies in a manner that ensures that the individual and collective interests of all stakeholders are served and protected. So simple. uh, you cannot you cannot do harm to the corporate body. You should develop such a type of affairs that will have some rules and regulation, which at the end will ensures the individual and collective interest of all the stakeholder, on the basis of which, on the basis of serving and protected mentality, like uh, what the investor or the what the external stakeholder demands. They demand that if they invest in any organization, their investment should be served efficiently and their investment should be protected effectively. So these are the definitions, like these are the only definitions, and still we are in the week 8. So in week 8 it doesn't mean that we are still studying the definition. These definitions are directly linked with your research activities. Okay, your research activity, what research activity that on the basis of this, or from these definition you came to know that corporate governance can be divided into two primary, internal and external. Then you also know about the who are the internal corporate governance. That can be the board of directors, that can be the internal audit committee, that can be the owners or management of the organization. So if you look at over here, so internal are the corporate bodies that control the CG activities. It can be Security Exchange Commission of Pakistan, it can be any government body, it can be State Bank, and it can be a government directly by itself as well. Talking about the research of the corporate governance, we can say that the internal corporate governance, like board of directors, okay, like you can see that internal corporate governance, corporate governance and internal corporate governance, you can find that you can find the, like for example, number one, the board of directors, okay, then audit committee, okay, then the board of directors, audit committee, and the third one is, like for example, the management or management, yeah, slash owners of the organizations, okay, owners of the organization. So what does this means? That these are the internal, and how you will link this with the research. If you Google this, that you just Google it and you write impact of, you just write impact of board of directors, generally board of directors on on firm performance, firm financial performance or firm performance, you can have a lot of research on it. So in a nutshell, what I want to say, that the current course you're studying is full of research as well. Similarly, if you write impact of if you write impact of audit committee, like on firm performance, you can have a lot of research on audit committee. Similarly, you can have, if you write impact of management or owners on the firm performance. So you just try it, you can try it, and you just, when you will write it in the Google Scholar, okay, open the Google Scholar, write impact of board of directors and firm performance, you can see a lot of research on it. So it's only this discussion was only to link the definitions with the research. Later on, I will also share a video with you people, like today, in today lecture. Similarly, how to find out the corporate governance variables that is used in the research. You will also have that video as well. Moving next, the difference between governance and management. Okay, now the point is that before this difference, we have studied about the corporate governance. Okay, about the corporate governance. Then we studied about the internal and external corporate governance, and then we just discussed about the research of the internal corporate governance. Like we have the board of directors in internal corporate governance, we have the audit committee in internal corporate governance, we have the management in the internal corporate governance. So what does this means? That the definition, from the definition you can find out the internal and external corporate governance mechanism. Even from the definitions, by discussion about the jobs, duties and responsibility among the participants, you can also find out the agency theory from here. And by discussion about the stakeholders, you can also find out the stakeholder theory over here. So now we will move to the broad difference between governance and management. So here we can say what governance do and what management do. Like in governance, you have to be very much strategic. Your objective, you have to set certain type of objective that should be viable, that should be realistic, and that should be achievable. And the most important thing, that you should be very much strategic. Governance points should be very much strategic. This will be future oriented, and this will be assessed with a reality. Okay. Similarly, setting objective in governance, you have to set the objective, devising plans to achieve these objective. Obviously, governance, in governance you have to make a strategic, there will be a strategic thinking about a problem, and in order to achieve that problem, you should develop some objective, you have to set some objective. Then third, you have to devise the plan to achieve these objective. Obviously, there should be some chain of the different plans in order to land on the objective, in order to achieve the objective, in order to get the objective. Then besides strategic, beside objective development, beside planning to get the objective, you have to set some rules or parameters which should not be violated, that should be followed. These rules and parameters should be followed. Why? Because these rules are directly linked with the objectives, and at the end your core aim is to get the objective. And the next one is not directly concerned with routine affairs. Obviously, it should be very specific. It should not be direct concern with the routine affairs. Routine affairs should be separated from the corporate governance. And more important, there should be protection of interests of all stakeholders. Obviously, governance rules, governance strategy, governance regulation, governance objective should be defined, should be developed in such a type of way that should guarantee the protection of all these stakeholders. So what is basically all these about? that everyone have to be very much vigilant whenever he will be a governance specialist. What will be happen? That he have to develop the strategic questions about the problem, strategic objectives in order to achieve that problem. And then what he have to do, he have to devise the plan, and on the basis of division, there will be some small step that have to be taken. So this is basically a governance. It's a overall, like you have, like from the definition you should know that what governance do. Governance minimize the agency cost. Governance take care of the stakeholder interest. Governance are not directly concerned with the routine affairs. Now coming to the difference between the governance we studied. But no, let's see the management. Like management are obviously they have to take care of the daily activity. That is why they have to be concerned with the current affairs, with the daily activities, with the daily routine. Similarly, management are very much interested in implementing the plan. So who will develop the plan? The governance guru will develop the plan, and implementation, the management will be the core responsible for implementing the plan. Similarly, developing suggestions and alternatives. Obviously, suggestions should be done, and in order to solve any problem, there should be so many alternatives. And most important, the next one is the operational matters. So what operational matters do or does? So operational matters are the routine activity or daily based activity that is very much important for any type of management. So in a nutshell, if we look the difference between management and governance, like governance is a strategic thinking on a broad way, while management is only a current affair. In governance, what you do, you have to look at the problem, and on the basis of the problem, you have to develop some objective, and in order to achieve that objective for solving the problem, you have to you have to devise some plans that will achieve that. However, in management, what you will do, you have to implement the plan that is already been developed. However, in management, you have to develop the suggestions with different alternative solutions. And in governance is not directly concerned with routine activity. However, management is directly concerned with the operational matters that can be a daily activities as well. So these are the simple definitions of the governance and the management and governance. Moving to our next slide, that is what is corporate bodies. Any company is a corporate body. However, in a broader sense, only public limited companies are taken to be the subject matter of corporate governance. Like you will be astonished, like they just simply answered that any company is a corporate body. This is very much true. However, in a broader sense, they just consider the public limited companies. And what is public limited company? That is registered on the stock exchange. And in order to give a power to these definitions, like in Pakistan, the corporate governance mechanism can be implemented on the listed company, that is public listed company. That is why corporate governance have a lot of concern with the public limited company. So far, the thirst of CG is only unlisted company. So very simple, we can say here in these slides you have to keep one point in mind, that any company is a corporate body. However, corporate governance is very much interested in the public limited company, in the that is registered on the stock exchange. In Pakistani culture, are talking about the Pakistani corporate governance activities. What is happening, that every public listed company that is registered on the stock exchange should follow the corporate governance standard. Or we, in a simple words, we can say that the corporate governance mechanism is mandatory for what, for the companies that is registered or that is publicly listed on the stock exchange. However, for other companies that is not listed on stock exchange, not on stock exchange, so here the corporate governance mechanism is not important for them. So in a simple way, we can say that CG can be directly implemented on a public limited company that is listed in the stock exchange. All those other organization which is not listed on the stock exchange, you cannot the corporate governance is voluntary for them. Going to our next slide, stakeholders in a company. We discussed these stakeholders for so many time. Like, who are the stakeholders? Obviously, those people who are directly or indirectly affected by the operations or by the any definitions or by any operations of the company. So we can say management and employees are the stakeholder of the company. Lenders like banks and other financial institutions are the stakeholders of the company. Suppliers and clients are the stakeholders of the company. Obviously, supplier and clients both are like customers. Clients are the, because of the policies of the company, both suppliers and clients can be affected. Similarly, shareholder are also very important stakeholder of any organization, is shareholder are going to invest in that organization. So on the basis of investments, what they do, they have to be directly affected by the decisions of the company. So stakeholder, society at large, obviously every society, even including the government, that can also be affected by the company decisions, company operations. So it also be considered as the stakeholder of the company. Similarly, we can say these can be divided into two: internal stakeholder and external stakeholder. And internal stakeholder, we can say management and employees, and shareholders, that like the owners, that is the in the internal management are the internal stakeholders, while lenders, suppliers, clients and society at large are the external stakeholder. However, you can have a lot of research on the internal and external stakeholder in the shape of sustainability, in the shape of corporate sustainability, in the shape of ESG, environmental, social and governance, in the shape of stakeholder theory, that how these internal and external corporate governance, how these internal and external stakeholders are affected by the companies, in the shape of, maybe in the shape of the pollutions. That pollution can be avoided, noise pollution, that can be an air pollution, that can be dust pollution, are the only directly environment. And a lot of work has been done and still on the way in order to help the stakeholders that are directly affected by the environmental health hazards. Moving to the next slides here, they just give the classification of stakeholders on the basis of owner, on the basis of lenders, employees, business associate, and they also talk about those with full opportunity, those with partial opportunities, those with virtually no opportunity. So these are the discussion and the classification on the basis of the opportunity to protect individual interest. So this is only a classification of stakeholder. Moving to the opportunity to protect individual interest, Manager and employee have the greatest opportunity to protect their interest, obviously. Similarly, supplier and clients essentially go by each transaction or contract. This is another important. Managers and employee have the greatest opportunity to protect their interests because both are working in the organization. That is why they can work for their protection of the interest. Similarly, what supplier do or does, they are very much interested in the transaction and getting the contract of the organization. This is in the shape of the opportunity that a supplier can get the agreement, or supplier can get the agreement transactions from the any organization. Similarly, lender and shareholder are most vulnerable. Obviously, these are the most sensitive people in any organization. The lenders, that can be a bank; the shareholder, that can be a common person who invest in the organization. Very much sensitive to the is although a lender and shareholder can get the opportunity, however these people are in the most of the risk as well. Society depends entirely on law, obviously. Opportunity, you have to depend, every society have to follow some rules and regulation. That is why that depends entirely on the law. Moving to, like, these are the opportunity. Manager can get the opportunities, employees can get the opportunity, suppliers and clients can get the opportunity, lenders and shareholder are also getting the opportunity, and overall society depends entirely on law. What is law? That can be in the shape of constitutions, governance codes, and so on. Up till now, what we discuss about the corporate governance. That what is corporate governance? Corporate governance is a mechanism through which organizations are directed and controlled. Then we discuss about the internal and external corporate governance. Then we talk about the research activity of the internal and external corporate governance mechanism. Similarly, we also had a discussion about the board of directors, about the audit committee, about the management of the organizations as well. Then we move to the difference between the management and corporate governance. Then we move to another slide, which is about the corporate bodies. So simply, any company can be a corporate bodies. However, we discussed that corporate body is always what is the corporate governance body. Corporate body is all those organization which is registered on stock exchange. Moving to our next slide, self-explanatory needs. Shareholder, that is the controlling groups. Internal, it can be internal, and out shareholder, that can also be the external. However, we can say both internal and external shareholder are directly affected by what? By the organization rules, regulation, and policies. That is why they're saying that corporate governance standard should come into way. It should be executed in order to safeguard the shareholders, either they are internal shareholder or they are external shareholder. Okay. Moving to the next, what is controlling group? If in majority can protect their interests easily, but they need monitoring, and if in minority can protect their interest easily, need high degree of monitoring. Okay, both can get the, or both can protect their interest. However, the point is that there is need of monitoring, there is need of time that should be given to the it should be given to the organization. So controlling group, both can control majority and minority. However, the point is that you have to be very much in monitoring phase, in monitoring shape. Outsider shareholders, this is another important discussions, that who are the outsider shareholder. We discuss about the stakeholder theory. That is one of the very renowned theory of corporate governance. Moreover, in stakeholder theory, you have to keep the care of the internal and external stakeholders. So here we are just going to discuss the outsider shareholder. In outside there is an institutional investor and individual or general public. So simple, like if there is a company, so who can be the shareholder in the shape of outside shareholder? There can be institutional investor, like some institution can invest in the organization. Beside institution, individual or general public can also invest in your organization as well. So these are the stakeholders, they took interest in your organization. Why they took interest? They took interest in order to maximize the shareholder wealth, their shareholder wealth. Who are shareholder? The institution can be shareholder and the individual can also be shareholder. Who are the lenders? Like lenders are institutions and individual both. Similarly, like we discussed about the shareholder, lender can also be the institution. And what type of institution? Like banks can also be the institution who can be in the shape of lenders as well. And general public can also lend you the money as well. Society at large, like government, clients and community, that can be taxes, law and orders, value for money. Client is always looking for value of money. And communities in the social rights. So if we look over here, so both these government, clients and community, these are the external shareholder that will affect the organization. Like government can be directly affected by the organization, or directly government can affect the organization will affect the government in the shape of taxes, in the shape of law and order situations as well. Clients, that can be an investors, that can be a supplier, that can be a person who demand the product, like a client as well. Community is like this. There is social rights and unsocial rights. What will be happen? Like every community have the right of environmental rights, like environmental rights, like air pollution, noise pollution and water pollutions as well. Moving to our next very important internal corporate governance mechanism. We discussed this a lot of time. The first one is the shareholder, then the board of directors, then the management, and then the employees. If you want to know the importance of all these corporate governance mechanism, these are the variables like shareholders, board of directors, management and employees. If you want to see the research about it, you can just, I just discuss with you, you just go to Google Scholar. You can have a lot of research on it. You even just you type, when you type like impact of shareholders on firm performance. Okay, you can have a lot of articles on it. Similarly, if you write impact of shareholders on capital structure, okay, you can have a lot of research on it. Similarly, if you want to change that, you can also write over here the impact of BODs, board of directors. You can also change board of directors. You can board of directors. You can also write this. You can also check the impact of management. Okay. You can also see the impact of management and performance. Similarly, you can also see the impact of employee. Okay, employee and firm performance. So all these things can be found in the research if you just type impact of employee and firm performance, or if you type impact of management and firm performance, if you type impact of board of directors and firm performance, and if you type impact of shareholder, you can have a lot of research on it as well. Moving to key players, once again, these are the key players. These are the players of the organization who are directly or indirectly involved in the organization, and you can see board of directors. He is the key player. He represents the interest of the organizations, and board of directors is the mechanism through which organization control different type of activity. So board of director is the part of the corporate governance, or we can say board of director is the variable of the corporate governance. Similarly, CEO, senior managers, and shareholder are also the people who are involved in the organization, who are involved in the organizational structure, executions of the corporate governance mechanism, and so on. Moving to our next slide, that is scope of corporate governance on the basis of objectives, interests, and the basis of tool and techniques. You can see there is like who has the individual interest and who have the collective interest of all the stakeholders. Like we can see who are the stakeholders. The first stakeholder is shareholder, then the lenders, then the employee, then the business associate, and the society. So these are the stakeholders like shareholder, lenders, employee, business associates, and societies. These are directly or indirectly affected by whom? By the businesses. Okay, what is the objective of the shareholder? Obviously every shareholder will want a sustainable growth in a net worth. Similarly, what basically lender want, or what is the interest of the security or timely interest payment, because lender are the banks, they need the interest which should be paid on the time. Employees continued employment at good terms, the interest of every employee that he want to continue employment in any organization, but the terms should be good. Similarly, business associate contributed business at a good term, they want to continue, but this continuation should be good terms. Society, good citizenship by the company as well. So all these are like collective interests of all is continued profitable existence, and the tools and technique that should be used, that is general management, legal framework, professional codes, industrial practice. So all these things as a technique should be used on the objective of whom, of all these stakeholders. Okay, so any question up till now?